Welcome to today's Explainer. We're diving right into a topic that literally shapes risk in the financial world, and that is SASB metric FMF270A.1. We're going to look closely at the anatomy of complex mortgages and figure out exactly how lending entities are required to track these underlying risks. So if you love understanding how the macroeconomy is built on micro-level data points, you are in the perfect place. So how exactly do we measure the hidden risks lurking in a mortgage portfolio? When an investor or a regulator looks at a bank's balance sheet, a mortgage often just looks like a completely standard asset. But beneath the surface, the specific terms of those loans can harbor explosive, totally unseen dangers. This explainer is all about the diagnostic tool we use to bring those hidden dangers right into the light. To really get why we measure these specific lending metrics today, we kind of have to look back. The 2008 global financial crisis was an absolute wake-up call for everyone. It acted as this massive primary catalyst for a significant regulatory shift toward consumer protection, transparency, and accountability. It proved that complex, poorly disclosed lending practices don't just hurt the individual borrower, they can trigger entire systemic economic collapses. Standardized reporting is how we make absolutely sure that history doesn't repeat itself. Here is our roadmap for today. 1. The risk in lending practices. 2. Meet metric FEMF270A.1. 3. Unpacking complex rate mortgages. 4. The prepayment penalty factor. And 5. Structuring the final report. Let's start with part 1, the risk in lending practices. So how exactly does a portfolio become toxic in the first place? Well, a lot of times it starts right with employee incentive structures. If loan originators are getting paid purely based on volume, they might unintentionally push unsuitable lending products to their clients. Add in a lack of transparency regarding complex add-on products, and suddenly you've got a recipe for severe regulatory scrutiny and incredibly costly litigation. For long-term investors, having a high concentration of these risky products represents a massive, massive vulnerability. All right, moving on to part 2. Meet metric FNMF270A.1. Now, what's really interesting is exactly where this specific metric lives within the broader SASB framework. Right under the lending practices topic, FNMF270A.1 requires entities to disclose both the quantitative number and the presentation currency value of very specific types of residential mortgages. It's not just a narrative summary, It's hard data designed to reveal exactly how much exposure an entity has to complex, potentially unstable loan structures. Which brings us to part 3, unpacking complex rate mortgages. Okay, so the first major category we need to look at is the combined fixed and variable rate mortgage. Basically, these are contracts that shift. They start out nice and stable with a fixed interest rate period, but eventually they transition into a variable interest rate period. That transition is usually triggered by a specific reset date or an exercisable option. The major risk here is payment shock, because when that rate finally shifts, a borrower's monthly payment can just skyrocket unexpectedly. Now, this standard gets incredibly precise. SASB doesn't just say, hey, track all combined rate mortgages. No, it specifically targets 3 high-risk subcategories under this umbrella. Mortgages with interest rate resets of less than 5 years, mortgages with interest-only payment schedules, and mortgages featuring negative amortization. These 3 specific features historically correlate with much, much higher default rates. Let's break those down. First up, an interest-only mortgage. It's exactly what it sounds like, a single-family residential loan where, for a specified period, the borrower's scheduled repayments literally only cover the interest. So the really crucial point here is that during that initial period, the borrower isn't paying down a single cent of the actual loan principal. They aren't building any equity through their payments, which leaves both the borrower and the lender highly exposed if the market takes a downturn. Then we hit the most complex of the 3, negative amortization mortgages. Let's do a quick mental scenario to really grasp this. Imagine you make your required monthly mortgage payment right on time, every single month. But because that required payment is set so artificially low, it doesn't actually cover all the interest the loan generated that month. So what happens to the leftover interest? Well, it gets tacked right back onto your total debt. So despite making your payments, your total principal balance is actually going up. And this brilliantly illustrates the stark difference. In a safe, traditional mortgage, you're slowly but surely walking down that mountain of debt. Your principal balance steadily decreases with each and every payment. But with the compounding danger of negative amortization, your balance increases despite making payments. You're walking up the mountain, even though you feel like you're paying your dues. It is really easy to see why investors demand transparency on exactly how many of these exist in a portfolio.
All right, on to part 4, the prepayment penalty factor. This is where prepayment penalties enter the chat. These are essentially monetary fees, or penalties, charged to a customer simply because they try to settle their mortgage balance early, before the end of the contract term. Tracking how many customers are trapped by these early exit fees is a genuinely crucial indicator of a lender's consumer protection posture. I mean, if a bank is issuing complex negative amortization loans and then locking borrowers in with heavy prepayment penalties, yeah, that is a massive red flag for regulatory risk.
Finally, part 5, structuring the final report. Before we look at the final numbers, let's confirm exactly what's included in the scope here. The reporting entity has to provide both the absolute number of loans and their monetary value. And critically, this isn't just about primary mortgages. The scope explicitly sweeps in first lien and junior lien single-family mortgages. It fully includes home equity lines of credit, or HELOCs as we call them, and home equity loans. So actually, scratch the idea that this is just primary loans. Second mortgages are scrutinized just as heavily as the first. So, let's see how all this builds into the official reporting structure. When you look at the SASB framework's required table, it acts as a really clean, strict blueprint. The data rows align perfectly with what we just talked about. Combine fixed and variable rate mortgages with resets of less than 5 years, prepayment penalty mortgages, and then the total residential mortgages, just for context. And across the top, they report the raw number and the total loan value. It's incredibly direct and to the point. Now, while that baseline data is the strict standard, SASB actually notes that entities are encouraged to take things a step further. Lenders can and really should disaggregate this disclosure by customer characteristics. And the big one here? Creditworthiness. Breaking this data down by the borrower's credit score provides even greater transparency. It shows investors whether these risky, complex products are being disproportionately sold to vulnerable subprime borrowers, which, as you can guess, massively multiplies the systemic risk of default. So we've unpacked the definitions, the scope, and the exact reporting structure for SASB metric FMF 27A.1, which leaves us with this final, genuinely provocative question. Is your portfolio masking systemic risk? By forcing transparency on complex variables and prepayment penalties, this metric ensures that the hidden dangers of the mortgage industry are finally pulled into the light. I challenge you to look at the financial disclosures of any major lending institution through this new lens. Thank you so much for joining me on this explainer. Keep asking the hard questions and keep learning.